You're listening to Investor Insights Decoded, the podcast where our hosts, Michael Grant and Julia Foster, break down the most impactful memos from the world of investing. Today, we'll be exploring Howard Marks's memo, The Route to Performance, written on 12th of October 1990. Let's dive into the timeless insights that continue to influence investors today. Hey everyone, welcome back. You know how sometimes it feels like everyone's pushing you to make the riskiest investment bets possible?
Oh, yeah.
Like it's all about chasing those huge returns.
Right.
Well, today we're looking at a different philosophy.
Okay.
We're going back to 1990 with a memo from Howard Marks, where he really dives into this idea of consistent performance and, get this, avoiding disasters.
Interesting. So sidestepping those big losses rather than always swinging for the fences.
Exactly. And what I find so interesting is that even back then,
Yeah.
Marx was pushing back against that whole get-rich-quick mentality.
Yeah, it makes you wonder if some things never change.
Right. So to illustrate his point, he compares two totally different investment approaches.
Okay, I like where this is going. Lay it on me.
Okay, so picture this. One firm's constantly lagging behind the S&P 500.
Uh-oh. Not a great sign.
Not really, right? But they're always making these big, bold bets.
So high risk, high reward kind of deal.
Exactly. Yeah. But are the results there? Not consistently.
I see. So their whole thing is that you got to be willing to be at the bottom.
Yeah.
If you ever want a shot at being at the top.
Which sounds good, like as a motivational quote or something.
Okay.
But is that really how you build long-term success?
That's the million-dollar question, isn't it?
And Marx would say no, which he illustrates beautifully with his next example.
I'm intrigued. Let's hear it.
He talks about this Midwestern pension fund.
Okay.
And their whole approach was completely different. They were all about those consistent, slightly above average returns year after year.
Interesting. Slow and steady, huh?
Exactly.
Yeah.
No chasing those home runs.
What happened?
They absolutely crushed the S&P 500 over a 14-year period.
Wow. Okay, so much for needing to hit home runs.
Well, right. Makes you think. It's kind of like the tortoise and the hare, but for your portfolio.
Love that analogy. But how do you actually put that into practice? What's the secret to getting those consistent above average returns?
Well, that's where it gets even more interesting.
Oh.
Marx doesn't exactly give us a magic formula.
Right. There's no such thing in investing, sadly.
Exactly.
Yeah.
But he stresses just how crucial it is to avoid those major losses, especially in volatile markets.
Okay, that makes sense.
Because, as he argues, even 1 year of really bad losses can just wipe out years of gains.
Yeah, that's a tough pill to swallow. Yeah, it's more about not letting those big losses take you down rather than only focusing on the huge wins.
Yeah, so it's not just about picking those winners.
Right.
It's about dodging those landmines that could really blow up your portfolio.
Exactly. And that's where his whole emphasis on avoiding disasters comes in, you see.
Okay, so how do we actually put that into practice?
Yeah.
Like when we're actually picking investments?
Right.
Does that mean just playing it safe all the time?
Well, it doesn't have to be about playing it safe. It's
Okay.
more about understanding, really getting a feel for the risks that come with different types of investments,
Okay.
and then making smart decisions based on how much risk you're comfortable with.
So tailoring it to your own risk tolerance?
Exactly. And Marx actually goes into a few examples to show you how this works, like convertibles, high-yield bonds, distressed debt, things like that.
Let's talk about convertibles for a second.
Okay.
What makes them such a good example of his philosophy?
So convertibles, they're kind of cool because they're like a mix between stocks and bonds.
Right. They've got that potential to convert.
Exactly. So you get the upside of a stock if the company does really well.
Right. You can ride that wave.
But you also get a little more stability, like you'd have with a bond.
Okay, so that's interesting.
Yeah.
But where does Marx focus on downside protection come in?
Well, he'd tell you to look beyond those tempting potential gains you could get from the stock part of it,
So don't just focus on the stock-like returns.
Exactly. You have to make sure the bond itself,
Yes.
the underlying bond, has good fundamentals. You need to know it would do okay even if the stock part doesn't go as planned.
Oh, I see. So it's like having a backup plan.
Yeah, exactly.
Yeah. Just in case things go south.
Right. So you're not betting everything on just the company being a massive success.
Right.
You're also looking at the bond's own strength.
That's a really interesting way to think about it. So you're kind of like hedging your bets a bit?
Exactly.
And he uses that same kind of logic with things like distressed company debt.
Right.
Which, to be fair, is a whole other level of risky.
It can be, yeah.
Yeah.
For those who don't know.
Yeah, let's break that down a bit.
Distressed debt, that's when you're buying up the debt of companies that are, well, let's just say they're not doing too hot.
Yeah, they're in a bit of a rough patch.
To put it lightly. And it's super risky because the company could actually go bankrupt.
Yeah, that's the big fear, right.
Right. But there's a but. If you choose right and the company manages to turn things around.
Get back on their feet.
Exactly.
Yeah.
The returns can be massive.
Okay, so it's high risk, high reward.
You got it.
So how does Marx deal with that, with so much on the line?
Well, his philosophy is all about only investing if he thinks those company assets, even if they're struggling,
Right.
are worth more than the debt he'd be buying.
So even if the company totally tanks,
Yeah.
he could still potentially get his money back.
Exactly.
That's really smart. It's like having a safety net, even when you're walking a bit of a tightrope.
Yeah, it's all about minimizing that downside,
Right.
even when you're in a riskier part of the market.
It's like, I don't know, it kind of feels like shifting from offense to defense.
Yeah,
You know,
I get that.
most people think investing is all about finding the next big thing.
Right, like picking the next Apple or Amazon.
Exactly. But you're saying it's more about not losing money on the companies that, well,
That go belly up.
yeah, basically. It's not that you can't find those winners, of course,
Right.
but it's more about, I think, building a portfolio that can take a hit,
Okay.
a portfolio that can handle those inevitable market swings and still come out on top. Because let's be
Yeah.
real, not every investment's going to be a home run. True enough.
Yeah,
And that brings us right back to Marx's idea of consistency.
exactly.
It's not about having one amazing year.
Right.
It's about consistently doing well over time.
Year after year.
Yeah.
That's how you build real wealth.
It's like that compound interest idea,
Exactly.
but for your entire investing approach.
I love it. Couldn't have said it better myself.
But, okay, this has been super helpful. But
Yeah.
are there any times when this might not be the right approach?
Oh, that's a great question. It's not, one size fits all. Like, let's say someone's young
Okay.
and they've got a lot of time to let their investments grow.
They have longer time horizon. Yeah.
Exactly. They might be cool with taking on more risk.
Makes sense. They have more time to recover if something goes wrong,
Precisely. Or, maybe they have a specific goal in mind.
like a financial goal,
Yeah, that needs a higher rate of return.
even if it comes with more risk.
Exactly. But this approach, the way Marx lays it out, it's really for investors who are prioritizing the long game,
Long-term growth, protecting what they've earned.
Exactly. Building a portfolio that can ride out those market storms and still deliver those consistent returns.
So it's not about being totally risk averse.
Right.
It's about really understanding your own risk tolerance.
Exactly. And doing your homework.
Right. Really getting to know your investment.
You can't manage the risk if you don't know where it is, right?
That's such a good point.
Yeah.
This has been incredibly insightful. I feel like we've covered so much,
We have.
but that core message is just so powerful.
It really is. And what's fascinating? How relevant Marx's insights from back in 1990 still are.
I know.
Things have changed, sure, but those basic ideas about managing risk?
Right. Building a resilient portfolio.
Exactly. Those are timeless.
They really are. So for our listeners who are now like totally on board with this whole philosophy,
Yeah.
what's the one thing you really hope they take away from this?
I'd say the biggest thing is to remember that investing, it's not just about picking winners.
Right.
It's about understanding and managing the risks involved.
Right.
Building a portfolio that matches your risk tolerance, your time horizon,
Yeah.
and that's built to deliver those consistent returns over the long term.
And sometimes
Yeah.
that means focusing more on not losing money than chasing those massive wins.
Absolutely, because just like Howard Marks said, sometimes the best way to win is by not losing in the first place.
So true. Words to live by, I think, both in investing and in life.
Ah.
Well, that's about all the time we have for today's deep dive. We hope you found this exploration of Howard Marks' investment philosophy as insightful as we did. Until next time, keep learning, keep questioning, and keep diving deep.